Y no nos alejamos de la actualidad, no nos alejamos de Donald Trump. Vamos a saludar ya. Robert Milano is a senior investment strategist and head of equity business development at Alliance Bernstein. Thank you very much for being with us today. Hello.
Thank you very much. Appreciate you having me here.
Trump's inaugurations took place on this past Monday, and we saw him announce a huge number of executive orders. While there is still uncertainty about how the Trump administration's policy agenda will unfold, do you have any thoughts on what the potential impact will be for equities?
Yes, indeed. So Trump's America First agenda certainly puts a spotlight on U.S. equities, and he's looking to perpetuate U.S. exceptionalism. Right? We've seen this for quite a long time, but he's looking to bring back manufacturing to the U.S., make U.S. exports more attractive, use extensive deregulation and tax incentives to make the U.S. a more attractive home for capital. In the last few days, as you mentioned, he's already signed a number of executive orders. Those focus on everything from border security to establishing the External Revenue Service and the Department of Government Efficiency. Also, we had last night's announcement of Stargate, so a JV which aims to make the U.S. an AI superpower, right? So I think the market has had some relief that the extreme commentary that Trump was kind of spouting along the campaign trail around tariffs has died down a little bit, which has helped the market to move a bit higher over the last two trading sessions. But that uncertainty does still exist. And I think that the takeaway for equities here is that likely going forward, we're probably going to see more volatility, right? And we experienced this in the past as well. In the prior administration, while we did see some rallies in the initial portions post-election in 2016, we had seen some fits and starts in the market after that. So I think we just need to be very sensitive to the fact that this is not going to be a straight line, right? There's going to be some curves along the way.
Robert, with that in mind, what is your outlook for equity markets as we continue through 2025?
Yeah, kind of extending off that last thought that I had, right? We know that the impact of Trump's policy plans will have varying effects across markets and regions and sectors. It's really hard to forecast, right, with any kind of certainty. So some of these policies might look dramatically different from what he promised. We still believe that active management here makes a lot more sense given some of that volatility that I spoke about. The last couple of years, passive has been the right place to be. You've had a very small subset of the market really driving most of the market's return, especially in the US, which has made it really difficult for active management to beat the benchmark, especially when you're looking at concentration limits in your funds and everything else. So when we look at the shorter period, if we just look at the year to date, which is only about 3 weeks now, but if we look at the year-to-date, the equally weighted S&P through yesterday's close has outperformed the market cap weighted S&P by about 100 basis points. If we look at value versus growth in the U.S., value has outperformed growth by about 270 basis points. Global and international markets have actually held up reasonably well and kept up mostly with the S&P, so that's been a solid development. What we have seen, though, is EM continue to underperform versus the broader market. Beyond just initial market performance, I mean, if we look at the U.S. economy more broadly, growth there continues to be solid. Inflation has been coming down, but is a bit more resilient than I think the Fed and people have anticipated. This has created a bit of volatility in markets, especially in the period from kind of December forward, as investors had to recalibrate their expectations about how long it will take the Fed to normalize interest rate policy. So as a reminder, solid levels of earnings growth, solid levels of economic growth, employment that's okay, not imploding, moderate levels of inflation, that's generally good for risk assets. So from an economic point of view, I think we're in a pretty good spot. There's still uncertainty around the impact that tariffs might have on the deficit, on debt levels, on inflation. That's all been reflected in the bond market in the last couple of months since the election outcome in November. But if we're in an environment of higher inflation, investors do need to have exposure to equities because equities generate real returns that can help to drive longer-term growth of capital. for client portfolios. And just kind of moving over to earnings and valuations, corporate earnings are actually expected to be quite strong this year and next. So looking at mid-teens earnings in 25 and 26 based on consensus forecasts. If you look at that outside of the Mag 7, which have driven most of the earnings for the U.S. market the last few years, you're starting to see a bit of a broadening in earnings expectations for the rest of the market, which is certainly a positive. And when we look outside the U.S., if that's developed markets, emerging markets, Japan, the Eurozone, you're still looking at kind of mid to high single-digit earnings growth, maybe even into low double-digit earnings growth, which generally is quite supportive for stock prices over the longer term. The question, though, is more around valuations. So valuations in the U.S., if you take the S&P at face value, are a bit extreme, right? They've been high, and that's driven by a small subset of names. If you strip those names out of the S&P and you just look at the equal-weighted S&P or the S&P X the Mag 7, you do see valuations that are a bit more reasonable. And when you look outside of the U.S., if that's, again, Europe or EM or looking at developed markets, international equities, you do see valuations that are not demanding. So all of that is quite interesting. If we look at a solid corporate earnings backdrop, valuations which can be okay, the challenge we have is economic divergence. But again, that comes back to the idea that to navigate this successfully, portfolios are going to have to work harder, and you're going to need more active management to do so, right? To identify the companies that are well positioned given a lot of the cross currents that we're seeing.
Robert, healthcare was a notable laggard for the last several years. Now there is increased uncertainty under the Trump administration. What are your thoughts on the sector, and is this still an interesting place to be for investors long term?
Yeah, look, healthcare, to be very candid, has been a disappointing part of the market. I mean, if we look at the factors that influenced healthcare performance in 2024, it ranged from kind of election level or election year jitters. People were a bit nervous about what the outcome would be, how that would impact different parts of healthcare. Now, post-election, you had Trump's nomination of Robert F. Kennedy Jr., which created some volatility. But even with that, all in mind, you did have some fundamental disappointments in different parts of healthcare, factors in the healthcare. If you look at factors across the healthcare sector as well, profitability underperformed, value factors performed a bit better. So there was quite a lot going on last year that created a bit of relative underperformance. And the other thing that overarches all of this is that the market has been primarily focused on AI and AI beneficiaries, but specifically within tech. You have not really seen the AI beneficiaries within healthcare, where arguably you have a tremendous opportunity to make the system more efficient and to deliver a better outcome for the patient. You haven't really seen that yet be rewarded. So for us, if you look at forward earnings growth expectations for healthcare, the growth expectations are still quite good, especially versus the rest of the market. To us, healthcare offers that unique combination of offensive and defensive capability, where you've got a really interesting level of innovation, you've got a lot of growth potential coming out of healthcare. We're all getting a lot older, unfortunately, and we need to access the healthcare system. So we need to come up with novel ways to deliver better outcomes. The challenge has been more around valuations, around some of these kind of headwinds that we've faced, especially post-COVID, utilization headwinds. So we think that if you focus on higher quality players within healthcare, those that are profitable, that have solid levels of reinvestment that can drive longer term growth within the sector, we think those companies can be a bit more resilient and can deliver attractive longer term returns for investors and make this a really interesting place to be, especially recognizing that the inflation problem isn't really solved yet, right? We're making progress in the right direction, but healthcare is an area of the market where if we see volatility, healthcare should be reasonably defensive. And also, they're not terribly impacted by a slower global economy, because either way, if you have to go to the doctor, you have to pay for care, right? You can't defer your care indefinitely, given some of the, given where we are in the economic cycle, right? If that makes sense. So yeah, we're still overly positive on healthcare, but recognize that there's been some challenges.
And growth stocks dramatically outperformed these value stocks last year, led by the Magnificent Seven. From a style perspective, Do you expect growth to continue to reign in this year, or do you believe that we'll see other parts of the market perform better?
Yeah, look, as mentioned earlier, I think, we've seen value, especially in the US, outperform growth by almost 3% on a year-to-date basis. That's a very short period of time, right? So I recognize that I'm being very optimistic that value looks interesting today, right? I think the value there is not necessarily that we're seeing really challenged fundamentals. I think value today looks a lot different from value 20 years ago. There's some interesting businesses that fall into this part of the market where valuations are quite interesting, and you've got solid company level or company specific drivers that can help to support earnings improvement over time. So you can get some higher quality businesses within value that are exposed to some really interesting longer term secular themes. And that aligns well with some of Trump's policy. If you think about things like deregulation that will benefit areas like energy and like financials. If you look at things like deglobalization or domestic production or even the nearshoring of production, that may benefit in a bigger way industrials, which tend to be concentrated in areas like value. There's the energy transition and independence theme that's kind of running through that Trump talked a lot about recently. So you tend to have some areas of value that should be supported in this type of a market. So if all this plays out as Trump says he will, as he intends for it to, we think that you'll see some stronger relative performance within value, especially following a period of immense concentration in the market, as we see investors kind of rebalance themselves back from growth, maybe to bring themselves a bit more of a core or balanced exposure within their equity allocations. And outside of the U.S., I think some of the fears around Europe are a bit overblown, right? Of course, there's their own slate of challenges here, right? Europe is facing more difficult economic picture than the U.S. is. We have the looming threat of tariffs by Trump. But if we think about some of the exciting business models in this space, there's a lot to like in some of the growthier parts of the European market. If you could find a business that has structural drivers of growth, that has good pricing power, those that sell a good amount of their products or services outside of Europe specifically and export that to other parts of the world, you have more resilient drivers of demand that maybe aren't as exposed to some of the challenges that Europe is facing more broadly. And then if you think beyond that, even some of the European companies have created domestic operations within, say, the US. So is it possible that those companies are less exposed to tariff risk? We do think so. We think if you can find some of those businesses, you can still deliver returns despite what is a more challenging backdrop. And then the last area that I'll talk about, just as we think about other markets performing better, this might be a contrarian call, but I think emerging markets look quite interesting. China's faced its own growth headwinds. You have increased demand for stimulus there. You've got the looming threat of tariffs, but Chinese companies have generally navigated tariffs and the last administration quite well, right? If you look at overall, China's exports to the rest of the world have increased in the last several years, even though maybe their exports to the U.S. hadn't. So there's quite a bit there on the China side, but even still outside of China, looking at emerging markets more broadly, there are a lot of companies that deliver products or services that are well exposed to some of the secular themes that are driving U.S. markets. So if you think about things like AI, you can find companies in emerging markets that create really interesting products, if it's cooling technology or other things, that leave them well exposed to some of the themes that we're all really excited about. But of course, given some of the challenges that we face in emerging markets, active is a really vital part of a client allocation there, just because it's such an inefficient part of the market where there's less research, where there's a lot more volatility and cross currents, that you want to be active to try and isolate some of those drivers of alpha over time. So again, contrarian, but given the earnings growth prospects and what are not demanding valuations, we think emerging markets could be an interesting call for investors as we progress through this year, and especially if some of the concerns around tariffs and other geopolitical risk maybe die down a bit.
Robert Milano, Senior Investment Strategist and Head of Equity Business Development at Alliance Bernstein. Thank you very much for being with us today.
Thank you very much for having me. Take care.
Thank you.